the average American household spends around $2,500 a year just filling up their gas tank. And as of this week, that number just got significantly worse because gas prices have surged 32% in under a month. But here's what nobody is telling you. The pump is just the starting point. The same conflict that torched gas prices has now pushed your 30-year fixed mortgage rate back above 6.5%, wiping out years of progress for home buyers overnight. It slammed the stock market. It is threatening to push inflation back up to 3% or higher, just as Americans were starting to breathe again. It even has recession odds climbing above 36%, according to market analysts this week. I'm Michael Harris, and today I'm breaking down exactly what the Iran conflict means for your gas prices, your mortgage, your groceries, your investments, and what smart Americans are doing right now to protect their finances before this gets worse. I'm Michael Harris, and if you have filled up your gas tank recently, glanced at your mortgage rate, or noticed that your grocery cart feels a little more expensive than it did a month ago, this video is going to connect a lot of dots for you. On the 28th of February, 2026, the United States and Israel launched coordinated strikes on Iran in what the U.S. military codenamed Operation Epic Fury. Within hours, Iran retaliated. And within days, the financial consequences began landing directly in the pockets of everyday Americans, from Dallas to Denver, from Chicago to Charlotte, from Phoenix to Philadelphia. Now here is what I want to be clear about up front. This is not a political video. I am not here to debate whether the conflict was the right call or the wrong call. What I am here to do is walk you through the cold, hard economic numbers that are already reshaping your daily financial life, whether you realize it or not. Because here is the reality. You do not have to follow geopolitics. You do not have to read foreign policy reports. But you absolutely do feel it when gas goes up $1. You feel it when your mortgage rate jumps half a point seemingly overnight. You feel it when prices at your local grocery store in Houston or Los Angeles quietly creep higher without anyone making an announcement. The Iran conflict is already doing all of that, and we are only about 4 weeks in. The single most visible and immediate impact on American consumers has been at the gas pump, and the numbers here are genuinely striking. According to AAA, the nationwide average price for unleaded gasoline hit $3.93 a gallon just over 3 weeks after the conflict began. Before the strikes on Iran, that same gallon of gas cost you $2.98. That is a 32% surge in less than a month. Think about that. 32%. If your grocery bill went up 32% in a month, there would be national outrage. But because gas price increases happen gradually, a few cents here, a dime there, most people are absorbing the shock without fully understanding where it is coming from or how much it is actually costing them. And here's why that matters so much. The average American household, according to National Retail Federation chief economist Mark Matthews, spends around $2,500 a year, which works out to roughly $50 a week, just on gas. That number is now meaningfully higher, and it disproportionately hits lower-income Americans hardest, because filling up the tank is not optional when you have to get to work every morning in San Antonio or drive across suburban Atlanta to pick up your kids. So why did the price surge so fast? The answer is the Strait of Hormuz. This is a narrow waterway off Iran's southern coast, and under normal conditions, roughly 20% of the world's entire oil and gas supply passes through it every single day. When Iran closed or severely restricted that waterway in response to the strikes, the world lost access to roughly 1/5 of its global oil supply almost overnight. That kind of supply shock does not take months to hit prices. It hits them within days because oil is traded on global markets, and panic and uncertainty get priced in immediately. U.S. oil prices climbed by roughly 42 to 43% from their levels before the conflict, reaching somewhere around $95 to $96 a barrel in mid-March. And Brent crude, the international standard, at points surpassed $110 a barrel before retreating slightly. But here's what's shocking, and I really need you to pay attention to this part. Gas is just the most visible number. It is the headline. The deeper economic damage is happening in places that are far less obvious. And those are the things that will affect your financial life for potentially months or years to come. Let's talk about groceries and food costs, because this one is going to surprise a lot of people. Food economics professor David Ortega from Michigan State University explained it really clearly. Food gets to your grocery store on diesel, whether it is on a truck or on a boat. Every single item on the shelves at your supermarket in Chicago or your Walmart in suburban Dallas traveled there on diesel fuel. When diesel prices spike, and they have, transportation costs for every single product go up. Then add the fact that fertilizer, which farmers across the Midwest depend on to grow the crops that become your food, is derived from natural gas. Higher natural gas prices mean higher fertilizer costs. Higher fertilizer costs mean higher prices at the farm level. And those costs eventually make their way to your grocery cart. Gregory Dacko, chief economist at consulting firm EY Parthenon, put a striking number on it. He estimated that the surge in gas prices alone could push monthly inflation as high as 1% in March 2026, which would be the highest monthly increase in 4 years. Yearly inflation would come in near 3% under that scenario. Before the conflict, U.S. inflation was sitting at 2.4% in January. J.P. Morgan economists gave a similar rough estimate. Now here is why that matters so much for your personal finances. When inflation runs higher, the Federal Reserve's entire plan gets thrown off. Rate cuts get delayed, and the cost of borrowing money for a mortgage, for a car, for a credit card balance stays elevated. And this is a good time to remind you, if you are finding this content valuable, go ahead and hit subscribe right now and drop a comment below. Tell me this. Are you feeling the Iran conflict in your wallet? Are you seeing it at the pump, at the grocery store, in your investment accounts? Let me know where you are feeling it most. Your comment helps the channel grow and helps me understand what topics matter most to you. Now let me explain the mortgage situation, because this one genuinely caught a lot of Americans off guard, and it is a big deal. Here is the context you need. Just 2 days before the United States struck Iran on the 28th of February, the average 30-year fixed mortgage rate had just dipped below 6% for the first time since September 2022. That was a massive psychological milestone. It was the signal that homebuyers across the country had been waiting for. Affordability was improving. Inventory was rising. Hope was building that 2026 would finally be the year the housing market unlocked. Then the war started, and within weeks, that momentum was completely erased. By the time of recording, the average 30-year fixed mortgage rate has climbed back to around 6.5%, and some analysts are forecasting it could push as high as 6.75% if the conflict drags on. That is a full half-point increase in under a month. Now, half a point might sound small. It is not. On a median-priced American home, that extra half point adds hundreds of dollars per year to your payment and thousands of dollars over the life of the loan. But here's where it gets even more interesting and more complicated. The reason mortgage rates jumped so fast has everything to do with the bond market, and understanding this connection is actually something every American homebuyer or prospective homebuyer should know. Mortgage rates generally follow the yield on the 10-year U.S. Treasury note. When oil prices surge and inflation fears rise, bond investors get nervous. They demand higher returns to hold U.S. government debt. That pushes Treasury yields higher, and higher Treasury yields push mortgage rates higher. It is a chain reaction, and it happens fast. The 10-year Treasury yield climbed from 3.96% on the 27th of February to 4.25% by mid-March, and mortgage rates followed directly. According to mortgage application data from the Mortgage Bankers Association, applications to purchase a home dropped 5% in a single week following the rate spike. Refinance applications dropped 15% in 1 week. That tells you something important. Regular Americans felt this change immediately, and they changed their behavior. People in Houston who were planning to buy this spring are pausing. First-time homebuyers in Phoenix who finally saw rates getting to a level they could work with are now back on the sideline. It is real, and it is happening right now. And the stock market has not been spared either. The Dow Jones Industrial Average fell nearly 800 points on a single day in early March as U.S. crude oil broke above $80 a barrel. The broad S&P 500 has also taken hits. For anyone with a 401k, an IRA, or any kind of investment portfolio, you have likely seen this reflected in your balances. Stocks and markets hate uncertainty. They can handle bad news if they know the full scope of it. What they cannot handle is open-ended geopolitical conflict where, as Fed Chair Jerome Powell himself admitted openly, the economic effects could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. When the chair of the Federal Reserve publicly says he does not know, that is not a reassuring statement for markets. And Morgan Stanley's head of U.S. policy summed it up clearly. Markets may tolerate uncertainty for a short period, but prolonged uncertainty becomes much harder to absorb. Now here is the critical bit, because I want to make sure we talk about what you should actually be thinking about and doing right now. There are smart, rational steps that make sense regardless of how long this conflict lasts. The first thing to understand is that this is not the first time America has been here. The economic playbook for an oil shock is actually fairly well understood, even if the outcome is not. In the 1970s, in 2008, and during Russia's invasion of Ukraine in 2022, every major oil shock followed a similar pattern. Prices spike, inflation heats up, Consumer confidence drops. Spending slows. Companies absorb costs for a while before passing them on. Eventually, prices stabilize or the underlying supply disruption resolves. That does not mean this one is harmless. It means the pattern is recognizable. For your personal finances right now, the single most important thing you can do is audit your variable expenses. Gas is obviously unavoidable, but are you making unnecessary trips? Are there 2 or 3 errands you could combine into one? At $2,500 a year in baseline gas costs, which is now higher, small behavioral changes add up. Carpool where possible. Work from home if your employer allows it, even 1 or 2 extra days a week. This is not dramatic, but it is real money. Second, if you are carrying credit card balances, this is not the time to be complacent. Credit card interest rates in the United States are already averaging somewhere between 20 and 27% APR. If the Fed delays rate cuts, or worse, if market pressures push rates higher, that credit card debt gets even more expensive to carry. Put every available dollar toward paying that balance down. Do not let a geopolitical conflict on the other side of the world compound into high-interest debt on your kitchen table. Third, if you are thinking about buying a home this spring, you now face a genuine decision. Mortgage rates that were just below 6% 2 months ago are now sitting above 6.5%. Housing economists from Zillow, Fannie Mae, and the Mortgage Bankers Association still generally forecast that rates could drift back toward the high 5s or low 6s later in 2026 if the conflict is resolved or contained. But as personal finance expert Alona Lamontovokova put it, trying to time the perfect mortgage rate is a losing game because the variables that move rates, like geopolitics, inflation, and Fed policy, are genuinely unpredictable. If the home makes financial sense at today's rate, do not let the hope of perfection stop you from a sound decision. Fourth, for your investments, do not panic sell. I know it sounds simple, but it bears repeating every single time markets get shaky. History is extremely clear on this. The investors who panic during geopolitical shocks and sell into the downturn almost always miss the recovery. Dollar cost averaging, putting a consistent amount into your index funds or retirement account every month regardless of what the market is doing, is one of the most proven strategies to ride out exactly this kind of volatility. The S&P 500 has delivered average long-term returns of 8 to 10% annually over decades. That average includes wars, recessions, pandemics, oil shocks, and every other kind of chaos imaginable. Stay the course. Here's what's also worth keeping in mind. The recession conversation is getting louder. Market prediction platform Calshare had recession odds sitting around 22% at the start of March 2026. By the 25th of March, those odds had climbed above 36%. That is still not a majority forecast. It means more analysts think we avoid recession than expect one, but it is a significant and rapid rise. The word stagflation, which refers to a painful combination of slow economic growth and high inflation simultaneously, is back in the financial media for the first time in years. Economists are drawing comparisons to the 1970s energy crises, and those comparisons are not made lightly. The situation also carries serious implications for the Federal Reserve's interest rate path. Just a month ago, markets were widely pricing in at least 1 or 2 Fed rate cuts in 2026, moves that would have brought relief to borrowers, homebuyers, and businesses across the country. That expectation has essentially evaporated. Some analysts are now openly discussing the possibility of a rate hike later in the year if inflation becomes embedded. Fed Governor Christopher Waller, who had actually voted to cut rates back in January, went on CNBC and acknowledged that a longer war means inflation is more of a concern. That is a notable shift from someone who was just months ago leaning toward lower rates. And the defense spending angle adds another layer of pressure. U.S. military engagement could push defense budgets significantly higher, with some estimates pointing toward a 50% increase in the defense budget, which would add further pressure on the federal deficit and U.S. government debt levels. More debt means higher Treasury yields, and yes, you already know where that leads for mortgage rates. What gives some hope, and what the financial markets have been seesawing on this week, is the talk of potential peace negotiations. President Trump has said discussions are ongoing through intermediaries, but Iran, as of the time of recording, has publicly rejected the U.S. proposal, while indicating it may allow limited passage through the Strait of Hormuz. Markets have been volatile on every headline. The Dow was trading around 300 points higher on some of those signals. But as analysts at Edward Jones noted, the recent developments are encouraging signals, not yet a resolution. And until the strait reopens meaningfully and reliably, oil supply disruption remains the defining economic fact of this moment. The Strategic Petroleum Reserve is another piece of this puzzle that deserves a mention because it directly affects how vulnerable the U.S. is to exactly this kind of shock. The Center for American Progress noted that heading into this conflict, the Trump administration had not refilled the Strategic Petroleum Reserve, which leaves the country with fewer tools to cushion a supply shock by releasing emergency reserves into the market. Other wealthy nations have pledged emergency oil reserve releases in a bid to calm the surge, but the scale of the Strait of Hormuz disruption is, according to the head of the International Energy Agency, the greatest global energy security challenge in history. That is not hyperbole from a random commentator. That is the head of the IA. For everyday Americans sitting in Chicago, in Los Angeles, in Houston, in Atlanta, the takeaway is not to panic. The takeaway is to pay attention, take smart practical steps to reduce your financial exposure where you can, and understand that this situation is fluid. The longer the conflict persists, and there are analysts who compare the duration risk to Russia's invasion of Ukraine, which kept energy prices elevated for years, the more it will seep from gas prices into groceries, airfare, utilities, and broader consumer goods. Companies will absorb higher transportation costs for a while, just as they did with tariffs, and then they will pass them on. Let me quickly recap what we have covered today. The U.S.-Iran conflict that began on the 28th of February, 2026 has already created a 32% surge in gas prices, pushing the national average to $3.93 a gallon and costing the average American household meaningfully more than the $2,500 a year they were already spending at the pump. The mortgage market has been hit hard, with 30-year fixed rates jumping from just under 6% before the war to 6.5% and potentially heading higher, wiping out months of progress for homebuyers and cooling the housing market at what should have been its most active season. Inflation is forecast to climb back toward 3% or higher. The Federal Reserve has effectively shelved its rate cut plans, and recession odds have more than doubled in just a few weeks, rising from around 22% to above 36%. Your grocery bill, your airfare, your utility costs, all of these are in the queue to be affected as higher energy costs work their way through the entire supply chain. The practical steps are clear. Audit your gas and driving habits. Aggressively pay down high-interest credit card debt before rates potentially rise further. Make your home buying decision based on the deal today, not on the hope of a perfect rate tomorrow. And for your investments, stay the course, keep contributing, and do not panic sell into the volatility. Click that like button if this video gave you real information you can actually use. Subscribe to FinTech Nation US because we cover the economic and financial news that affects your real life. Not just the headlines, but what those headlines actually mean for your money. Drop a comment below and tell me, where are you feeling the Iran conflict the hardest right now? At the gas pump? In your investment account? Are you holding off on buying a home? I read every comment, and your feedback shapes the content we create. Share this video with anyone in your life, a friend, a family member, a coworker, who is wondering why their finances feel different lately. Because the connection between what is happening overseas and what is happening in your wallet deserves to be understood. Next video, we are looking at what a potential stagflation scenario in America would actually look like for your personal finances, and how to prepare your budget now before it becomes a bigger reality. Until then, stay sharp, stay informed, and protect your money.